PayPal stock has surged this week as the stock is up almost 15% because of recent news that Stripe is interested in acquiring PayPal. So if you guys follow the channel, you know that I am a PayPal shareholder. With the recent spike, I am down about 10% in my PayPal position, so we'll cover the news and I'll also disclose what I'm doing with my position. Now regarding the news, it is still very early days. However, payments firm Stripe is considering an acquisition of PayPal or parts of the company, Bloomberg News reported on Tuesday, citing people familiar with the matter. For me, it is no surprise that now companies are interested in acquiring PayPal because PayPal has become incredibly cheap. The stock is down 82% in the past 5 years and down 37% in the past year, and now has a market cap of $43 billion. Now, PayPal has gotten cheaper, and I want to say this, PayPal is not a meme coin. This is a company that is generating $33 billion in revenue, up 4.3% compared to last year, and a company that is generating tons of cash. Last year, they made $5.2 billion in net income, and they have even more free cash flow. Now the company is trading at a 4P of 8, but we'll talk later about the valuation and how cheap it has gotten with a discounted cash flow model. And if we take a look at the financials, people say PayPal is a dead company. However, starting with the revenue, it has grown from $10 billion to $33 billion over the past decade. So they have grown revenue every single year. Now, yes, it is true that last quarter they reported 4% growth year over year, but this is still growth. And I believe PayPal still has segments of their business that could grow massively in the future. For example, last quarter they reported Venmo revenue of $1.7 billion, up 20% from the previous year. And keep in mind that Venmo is a platform that they have struggled to monetize, so there is still some potential there. And PayPal is a profit machine. In terms of net income, as we have seen in the intro, it has grown from $1.4 billion to $5.2 billion currently. Now, one thing that I really like about PayPal is that they have even more free cash flow, currently sitting at $5.5 billion. And this is because this company has great margins. Their gross margin is at 41%, profit margin are around 15%, and free cash flow margin at around 16%. And it's not like PayPal is a super risky investment. In fact, they are in a very stable financial position as they have $10 billion in cash and $12 billion in debt, so they could pay this amount of debt anytime they want. And they are generating tons of cash, as we have seen $5.6 billion. And with that extra cash, the company is returning a lot of value to shareholders. Number one, through paying dividends. The current dividend yield is 1.1%, which means you get about 56 cents per share annually for every share. And the payout ratio, which is what percentage of their profit is used to pay the dividend, is only 5%, which is incredibly low, and I expect this dividend to increase in the future. And another huge news for investors is that they have been buying back a ton of shares. As you can see here, as the stock has gotten cheaper, they have bought more and more shares, which is huge for investors. The last couple of years, they've bought back 6% of their shares annually. This is very positive for investors because you share the profits of the company with less people. For example, in the book 100 Baggers by Christopher Mayer, an amazing investor, he has a whole chapter on stock buybacks and how it can accelerate returns as you own a bigger portion of the company basically by doing nothing. And the main reason why Stripe, other companies, and myself are invested or interested in this company is because of the valuation. The company is now trading at a price to free cash flow of 7. By the way, if you want access to stockanalysis.com, which is where I've shown all the stock data in this video, you have my link in the description. PayPal is incredibly cheap at the moment, and in order to calculate the intrinsic value of the company and potential future returns, I use my Google Sheet, essentially a discounted cash flow model, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $64 per share, middle $88 per share, and high $118 per share. Now, after this recent run, the stock is currently trading at $47 per share, which means that if my low assumptions occur, you would get a 16% annual return on your money, middle 23%, and high 29.5%, which are insane returns. And I actually did extremely conservative assumptions, as I have PayPal growing revenue between 2.5% and 5.5% annually for the next 7 years, averaging a profit margin and free cash flow margin between 13 and 17%, and I assigned the PM price to free cash flow at the end of the 7 years of 12, 14, and 16. However, if you want to make your own assumptions, I'm going to leave a link to a spreadsheet down below. Super simple to use because I've done all the calculations in the background, so you only need to input your assumptions, and you can use this tool for any stock you want. And in my opinion, it is no surprise that companies are getting very interested in acquiring PayPal. Now, in terms of my position, as it is now one of my largest positions, I am not going to add more unless it drops back to that $40 range. And I just think the same as before, PayPal is a great investment and I would invest in the company even if it wasn't an acquisition candidate. I hope you found this video valuable. Let me know what you think about PayPal stock in the comments, and I'll see you in the next one.